Hi, this is Ken Boyd, the owner of St. Louis Test Preparation. Here's our page on the web, stltest.net, our homepage, where you'll find the books, the blog, the podcast, tutoring services, and our links to our YouTube videos. Topic I wanted to cover is one that I get asked an awfully lot about, which is consolidations and accounting for the differential along with consolidation. So I have a question here that takes a few tabs that may take more than one video. So a company called Piano is buying an interest in Steinway. Piano is the parent, Steinway is the sub. And so with the first step, we need to calculate the steps to come up with a differential. So step one for the whole problem is we're going to post a journal entry for the parent to account for that purchase. So 80% of the book value of the sub was acquired by the parent and they issued debt. So my transaction is Piano, the parent, buys 80% of Steinway, the sub, of that company's common stock in exchange for $320,000. Now, not all of it is cash. $60,000 in cash, $260,000 in the form of a note payable. Now, that's going to be an issue later on when we consolidate the financials. So if Piano, the parent's buying 80%, there must be a non-controlling interest that is buying the other 20%. And we're going to come up with that other 20%'s value of their interest here in a minute. So the first thing, on Piano's books, on the parent's books, we're going to debit a new account called Investment in Steinway for the $320,000. That's a new asset. Piano credits to reduce cash that they paid $60,000. They create a liability, a note payable $260,000, and we have debits equal credits $320,000. That's going to be the entry on Piano's books. Step two is if we know how much Piano paid for their 80%, we can calculate the value of the entire company, Steinway. And if we know that, we can figure out the non-controlling interest value. If we take the purchase price of $320,000 and we divide it by 80%, the amount that Piano, the parent, purchased, $320,000 divided by 0.8, blue divided by green, is $400,000. That's the value of the entire entity. So if Piano paid $320,000 and the entire interest is worth $400,000, that means that the difference is the value that goes to the non-controlling interest of $80,000. That's step two. Step three, we calculate the differential as the value of the entire company, $400,000, compared with the book value of the assets that are acquired if you buy 100% of Steinway as a company. Another way of saying that is we add up the equity of the sub, which in this case is $150,000, the difference between the fair value of the whole entity based on the payment by Piano, $400,000, and the book value of the assets that we acquired, $150,000, is our differential. And we say that the differential gets assigned to one of two places. It gets assigned based on the fair value of specific assets that are greater than their book value, and any price paid above that creates goodwill. So step four is let's assign the differential to both the fair value of assets and goodwill. So down here at the bottom, I have a fair value summary where we have specific assets. We're given book values and fair values, and we can calculate a difference. So for example, inventory book value $45,000 in green, fair value $55,000 in blue. There's a difference of $10,000. Now you'll note that the patent and the trademark had no original book value because a company cannot internally generate an intangible asset like a patent or a trademark and post it as an asset. Although when one company buys another company, you can create on the balance sheet intangible assets. So you'll see that the fair values are here, the book values were 0, which create these differences. So we add it all up and we find out that the fair value of these specific assets are greater than the book value by $170,000. So here's the book value of the assets acquired. If I add book value plus the fair value that I just figured out down here, I get $320,000. That is, in green, the fair value of the assets that are acquired, $320,000. So that $170,000 of the differential gets assigned to these assets. These assets are going to increase in value by these amounts in consolidation. So the amount that we pay above $320,000, the book value plus the fair value increases. That amount above $320,000 gets posted to goodwill. So we can go over and look at the first entries that we make for the end of year 1 to come up with consolidated financials, which is this column. I was given a balance sheet for Piano and a balance sheet for Steinway. You'll notice that here's the investment in Steinway account for the parent, $320,000. You'll also notice on the parent's books, Piano, here's that note payable of $260,000. So in consolidation, we do a couple things. I say step 5 is post the eliminating entries. We debit to reduce Steinway's equity because it no longer exists in a consolidation. We reduced it by debiting. We credit to remove in consolidation the investment in Steinway account on the parent's books. And we credit that portion that goes toward the non-controlling interest. And so you see we have a balanced entry. Debit to equity, here's the differential, investment in Steinway and the non-controlling interest. So the differential is the plug figure, and I say that it's a temporary account that will be removed later. A differential account never makes it to the financial statements. And you'll see in blue up here, and if you want this template, you can email me. In blue, you see the elimination entries for the first entry. The brown entries are the second eliminating entry, which says we're going to remove the differential by crediting. We originally debited it. We take these asset accounts and we increase them to their fair market value, debits. We create goodwill, $80,000 debit. That was the amount that we had back here. That $80,000, that's going to go to goodwill, so we debit to create a new asset account called goodwill. We take the differential off the books, debits equal credits, and you can see that the entries are up here in brown. Now the tricky part is getting this to roll across so that you have consolidated financials. You'll see that in the elimination entry columns, debit and credit, debits equal credit, so that's a good check figure. And then I add across and I end up with consolidated assets and consolidated liabilities and equity. And that total assets equal liabilities and equity, so I know I've done the problem correctly. So that's as far as we're going to get. We're going to do year 2 in another video where we have to account for net income, retained earnings impacts using the equity method. Remember that you can find everything at the website stltest.net. Links to all the books I've written, the blog, the podcast, tutoring services, and the video links right here. Thanks very much for watching, and we'll see you next time.